As the U.S. markets are closed for the weekend, we are looking at the final closing figures from Friday, October 17th, 2025. SoundHound AI, ticker SOUN, ended the session at $19.02. This was a very rough day for the stock, finishing down $1.74, a significant drop of 8.38%. The trading range on Friday was wide, swinging between a low of $18.53 and a high of $20.40, all on very heavy volume of over 47 million shares. Now, the immediate reaction is to blame the broader market, which was indeed weak. But the real story, the one that should have your attention, is that this slide accelerated right after news broke of significant insider selling, specifically from the company's own chief financial officer. This is where the narrative that many investors have bought into, that SoundHound is the untouchable AI pure play, starts to show some serious cracks. The expectation for SoundHound AI has been absolutely stratospheric. This is the stock that many people see as the next major disruptive force, the David in the conversational AI space that's genuinely taking on the Goliaths like Google, Amazon, and Apple. You look at the headlines and you see a company that was just named a leader in conversational AI by the Everest Group. You see them signing deals with major brands like Red Lobster to handle phone orders. You see them expanding their footprint in the automotive sector, a key market. And most impressively, you look at their last earnings report from August for the second quarter, where revenue exploded by 217% year over year. That kind of triple-digit growth is what investors dream of. It's the kind of number that makes people believe this isn't just another tech stock, but perhaps the next NVIDIA stock. The common belief is that SoundHound's technology is just better, faster, more accurate, and more adaptable, allowing them to win contracts that should have gone to the giants. But then reality sets in, and it hit hard this past week. The reality is that on October 14th, the company's CFO, Nitesh Sharan, sold over $1.28 million worth of SOUN stock. Now, the company is quick to point out this was part of a pre-arranged 10b5-1 trading plan, which is true. But the optics, especially for a high-growth, high-volatility stock that is still deeply unprofitable, are just terrible. It sends a signal, intended or not, of taking profits off the table, while public shareholders are still underwriting the company's heavy cash burn. This wasn't an isolated event either. Other key executives, including the CEO and CTO, also sold shares earlier in October. So while retail investors, perhaps on the Robinhood app or using SoFi Invest, are piling in on the AI hype, the people with the most intimate knowledge of the company's day-to-day operations are systematically selling. This creates a massive disconnect. The expectation is a company on the verge of dominating a new field. The reality is a company whose insiders are diversifying their own holdings at a rapid clip. This kind of tension is what defines SOUN stock right now, and it's why the share price is seeing such wild swings. Think about the whiplash investors just experienced. Just one day before this CFO news tanked the stock, on October 16th, H.C. Weinberg came out and reiterated their buy rating, jacking their price target up to $26 from $18. That news sent a jolt of optimism through the stock, contributing to a 9.7% gain just a few days ago on the back of another positive announcement about the full deployment of its Amelia 7 AI platform at Apivia Courtage. So, in the span of 48 hours, you had a major analyst pounding the table for a 30+% upside, followed immediately by the CFO dumping over $1 million in shares, which then triggered an 8.38% crash to close the week. This is not the trading pattern of a stable, mature company like Apple stock. This is the hallmark of a high-stakes battlefield stock. This volatility is precisely what attracts so many traders, whether they're using the advanced platforms at Interactive Brokers or a simple Fidelity mobile app. The volume tells the story. An average day for SOUN sees heavy volume, but 47 million shares changing hands on Friday shows a clear battle between the growth story bulls and the show-me-the-profits bears who were spooked by the insider sales. This heavy volume indicates that major positions are being established and liquidated. While we see top-tier institutions like Vanguard and BlackRock as major holders, which provide some stability, you can be sure that proprietary trading desks and hedge funds are also playing this volatility for short-term gains. This isn't a stock you simply put into a Schwab Intelligent Portfolios account and forget about. It's an active, high-maintenance position that demands daily attention. This kind of online investing requires a strong stomach and a clear understanding of what you actually own, because the story and the financials are telling two different tales. So, what does SoundHound AI actually do? Many people still associate them with their original music recognition app, but that's ancient history. The company's core business is its Houndify platform, which provides advanced, independent voice AI and conversational intelligence to other businesses. They essentially sell the picks and shovels for companies that want a voice assistant without being beholden to Amazon's Alexa or Google's Assistant. Their revenue is split between royalties, licensing fees, and subscription-based services. They have two major verticals. First is the automotive industry, where car makers use SoundHound to build their own custom branded in-car assistants. Second is the enterprise and restaurant space, which is where the explosive growth is coming from. This includes everything from the aforementioned Red Lobster deal to deploying sophisticated customer service AI agents like the Amelia 7 platform for large corporations. They recently bolstered this enterprise offering by acquiring Interactions Corporation, aiming to immediately enhance their operating profitability and cross-sell their services. This is a smart business model because it's sticky. Once a company builds its entire customer service or in-car experience around the Houndify platform, it is very difficult and expensive to switch. This is the bull case in a nutshell: massive revenue growth, sticky enterprise customers, and best-in-class technology that is winning in the open market. Now let's look at the future and tie this all back to the expectation versus reality framework. The next major event, the next big reality check, is the company's third quarter earnings report, which is expected around November 11th. This will be the moment of truth. The expectation, set by the company's 217% Q2 revenue surge and their own bullish guidance, is for another blockbuster number. Management guided for 2025 revenue to be between $160 million and $178 million, and, critically, stated they are targeting adjusted EBITDA profitability by the end of 2025. That last part is the key. The reality is that in Q2, while they beat EPS estimates, they still posted an adjusted EBITDA loss of $14.3 million. They ended that quarter with $230 million in cash and no debt, which sounds great, but a $14.3 million quarterly loss shows the rate of their cash burn. They are in a race against time. They must get to profitability before they burn through their cash pile and are forced to either take on debt or, more likely, issue more shares and dilute the very shareholders who have been so patient. This risk of dilution is not trivial. The share count has already grown substantially since the company went public. So here are the scenarios. The bull case: on November 11th, SoundHound reports reports another massive revenue beat, shows that the Interactions and Amelia acquisitions are integrating perfectly, and, most importantly, shows a clear, undeniable narrowing of that adjusted EBITDA loss. If they can do that, the $26 price target from H.C. Weinberg might look conservative, and the CFO sale will be forgotten as prudent personal financial planning. The bear case? The company meets revenue expectations, but the losses remain stubbornly high or even widen due to acquisition costs. This would signal that the path to profitability is longer and more expensive than previously thought. If that happens, all the focus will snap back to the insider selling, the stock's negative PE ratio of -30, and the terrifying fact that they are competing directly with companies that have trillions of dollars in cash. This is the fundamental risk. Can SoundHound, with $230 million, out-innovate and outspend Microsoft, Google, and Amazon? It's a tall order. Many traders looking for investment help or online investing sites are drawn to Sound, but they must understand this risk. It's not a diversified play. It's a concentrated, high-stakes bet on a single company's technological edge. Here's a question for everyone watching. Comment below what you think the biggest risk for SoundHound AI is: the intense competition from big tech or their own continued cash burn on the path to profitability. In summary, the story of SoundHound AI is one of the most compelling and conflicted narratives on the market today.